With all the investing gurus advocating the index funds, safe, simple, reliable, what if, just what if, you could beat the market with something completely random? Well, that's exactly what I decided to find out. In the last few weeks, I've been running an experiment. I invested in companies that start with the letter A to see if something as trivial as the first letter of a company's name could outperform the famous S&P 500 index. So here's the plan. The S&P 500, just to recap, is a benchmark of about 500 of the biggest companies in the US, like Apple, Amazon, and Alphabet. To even make it in, a company has to check some serious boxes. Be US-based, be listed on a major exchange like the New York Stock Exchange or Nasdaq, and have a market cap of at least 18 billion US dollars, and of course, be profitable. It's a pretty exclusive club, but instead of picking those top companies with intention, I just focused on one simple rule. Does it start with A? I pulled up the S&P 500 list, found 54 companies that start with the letter A, and voila, that became my portfolio. It is actually pretty diverse. There's tech, healthcare, real estate, utilities, you name it, it's there. I used Navixa, a portfolio tracker, to track the performance. I pretended I invested $1,000 in each of these letter A stocks 10 years ago on January the 1st, 2014. For companies like Airbnb that were not listed back then, I used their IPO date as my entry point. In total, I invested $55,000 into this A-list portfolio. To keep it fair, I also invested the same $55,000 in the S&P 500 index via the SPY ETF. Neither portfolio reinvested dividends, just pure growth and dividends income. Let's fast forward 10 years to see how my experiment turned out.
10 years later.
The S&P 500 index grew from $55,000 to $161,567. That's a capital gain of over $106,000 with an average return of 18% per year. We also received about $17,000 in dividends, bringing the total return to 21% per year. Let's look at the A-list portfolio. Surprise, surprise, my randomly selected A-list parcel has turned $55,000 to $260,000. That's a massive capital gain of $205,000 or 35% per year. Interestingly, the dividends were a bit lower at almost $16,000, but the overall return, 38% per year. Well, that was a pretty random and odd experiment, but it did teach me a couple of lessons. Number one, I didn't know enough of what I've been investing. This is so embarrassing to say.
It's embarrassing.
I had a sudden realization while entering some of these companies into Navixa. I didn't even recognize half of them. How is it possible to own a piece of a company and know nothing about it? It hit me then. I was basically following the herd. Just doing what everyone else was doing without really thinking twice. That's a classic investing bias called herding. We all do it, but it made me pause and wonder, how much do we actually know about where our money is going? Number two, doing average things gives average results. For this experiment, I didn't do any deep analysis, no research into their balance sheet or management teams, and yet these portfolio outperformed the S&P 500 by a huge margin. It made me realize that when you stick with the tried and true, like investing in the S&P 500, you get reliable but average returns. But if you step out of your comfort zone and try something different, even with a random approach like mine, there's a chance to outperform the market. It proves one worldly wisdom that apply beyond investing. Doing everything gives average results. Number three, diversification is a compromise. We all know the golden rule, don't put all your eggs in one basket. Diversification protects you from the unknown, spreading out both your return and risk. Diversification is designed to protect us from the unknown. Still, in this case, my randomly selected stocks outperformed the S&P 500 because some of those individual companies like Apple and Alphabet, Google, pulled the portfolio up in a major way. The legendary fund manager Peter Lynch said, you only need a few good stocks in your lifetime to make a lot of money. He believes that finding and holding on to a few high-performing stocks can be more impactful than diversifying into too many average or underperforming ones.
Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of five-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it. And they have incredible edges People have big edges over me.
Now, don't get me wrong. I'm not saying you should go out and invest in companies just because their names start with a certain letter. There was an element luck here, a big one. But this experiment shows that any index always has outliers, companies that will overperform and ones that will underperform. If you want to buy some of these direct shares, you will need to invest what you know and control your exposure to those betting stocks in case you made the wrong judgment. Lastly, I want to emphasize something critical. Past performance doesn't guarantee future returns. Just because my A-list portfolio outperformed in the last 10 years doesn't mean it will continue to do so. In fact, some of these companies might start underperforming, get disrupted by new technologies, or simply decline as the market evolves. Relying on historical data alone can lead you overconfidence. It's tempting to think, hey, if this worked before, it will keep working. But the market is ever changing, so while this experiment worked out in my favor this time, I wouldn't bet my life savings on a similar strategy without considering future trends and risks. Does that mean that you should ditch index funds and start picking stocks based on random criteria? Probably not, but it shows that there is always more to learn and explore. Let me know in the comments what is the craziest investing experiment you've ever tried or want to try. My name is Irene. I'll see you next week. Bye.